All right, you're live. Good to go, guys.
Okay, fantastic. This is the Town of Dewey Beach Investment Committee meeting, April 20th, 2023 at 6:41. We're going to get started with a roll call. Brian Prevost, Chair of the committee. Will the other committee members introduce themselves?
Dennis Trancher here.
Bernie Krause here.
All right. It looks like we're missing Michael Schaefer, but I'd observe we've got 3 committee members present for a quorum. Commissioner Gibbings.
I am also here. Thank you for
Fantastic.
including me.
And we have some others on camera with us from the town. Bill Zolper, town manager. Sheena Hall is with us as well. And with the others present, introduce themselves.
Hello, everyone. Richie Francia, Fulton Bank.
Okay, thank you.
Hello, Matt Rice, Fulton Bank.
Katie Wilkinson, Fulton Bank.
Bill Keatley, Fulton Bank.
Mike Wiggins, Fulton Bank.
Is that everyone? All right, fantastic. Next item on the agenda is vote to adopt the agenda. Is there a motion to adopt the agenda?
Motion.
Is there a
Go ahead.
second?
Second.
All in favor, say aye.
Aye.
Aye, it's unanimous, passes. Bernie, you're okay to serve as our secretary to record the minutes?
I am.
Very good. Our previous meeting minutes were posted on the town website. Does anybody have any questions or comments on those?
No.
No, not here.
Okay, no further comments from me. Is there a motion to adopt the previous meeting minutes?
Motion made.
Is there a second? All in favor, say aye.
Aye.
Aye, it's unanimous. All right, next item of business. Fulton Bank has asked, Fulton Bank, which for the public is the bank that holds our operating accounts, cash accounts for the town. And they have asked to make a presentation to make us aware of their investment options or capabilities as an investment advisor. I would note for the public that this is not up for any vote. There's no pending request for proposal. But this is a courtesy presentation so that we can learn more about a partner with the town that is already has an existing banking relationship with the town. So I'll turn it over to Fulton.
Thank you, Brian.
And
and
I'll
thank
also
you.
note for the record, I believe their presentation was posted on the town's website for those that want to follow along at home.
Yes, it was.
Perfect. So thank you, Brian, and the folks from Dewey. Most of you know Richie and Matt, who are your primary market covers in Sussex County for the town of Dewey. We very much appreciate the relationship that we've had with you for all these years and the partnership, and really are grateful for the opportunity to look for another way to potentially expand that. My name's Katie Wilkinson. I'm the market leader for Delaware for Fulton. In the interest of time, I'm not going to do a Fulton commercial, but certainly would welcome any of you to ask questions throughout the presentation or at the end, both about the bank and about the materials that you're going to hear tonight. So with that, I'm going to hand it over to Mike Wiggins so that we can spend more time on the investment management proposal. Mike.
Thanks, Katie. So Bill, Ted, and I work for Fulton Financial Advisors, which is the investment management division of Fulton. We're entrusted by clients to manage $15 billion. We have a group within the group that solely deals with nonprofits, including municipalities, and we're trusted by 50 municipalities to manage $1/2 billion. And that's pages 4 through 6. And the background on Fulton is the first 3 pages in the presentation. One of the key areas in which we can assist you is to provide corporate governance services, which includes risk profile assessment, asset allocation strategies, spending policies, and investment policy reviews, and maintenance and upkeep. At least once a year, we perform the calculations and provide our clients with specific recommendations in order to keep them in full fiduciary compliance. In a volatile year like last year, we're in contact a lot more frequently. But we'll proactively reach out to you. You don't need to chase us. Fulton is a full fiduciary. We're held to the highest possible fiduciary standard. You're hearing fiduciary more and more and more, and there actually are different levels. But the way Fulton is structured, we are at the highest level, and we are held to that standard by the Office of the Comptroller of the Currency. Not that you need to know that, but that's our chief auditing group. And that's a higher standard than your current provider. They're under the SEC, the Securities and Exchange Commission, which we're also governed by, but our higher power is the OCC. And how this is important for you, or how it benefits you, is that you can rely on our processes, our expertise, and our annual audits to fulfill part of your fiduciary responsibility. So you can offload some of your responsibility in those areas I just talked about, basically the investment issues, to Fulton, and full reliance and full compliance with the fiduciary issues that you have to comply with. After reviewing some of your holdings, we think that we can save you some time and money through consolidation, lower fees, and better performing investments. So on the consolidation front, you presently have 5 separate investment accounts. And according to your IPS, they can be consolidated into 3 accounts. So unless you guys are doing that for your bookkeeping purposes, it looks like we could save you some time and money by having less accounts to keep track of. Lower fees. Fulton is compensated by our clients only. We do not receive anything from our money managers that we use in your account, so we have no bias. 75% of your assets are invested in a single mutual fund that has an expense ratio of 0.5%, so 0.5%. The primary fixed income manager that we use is 0.2%. So again, some possible savings there for you. From a performance standpoint, that same bond fund that you hold in multiple accounts that makes up 75% of your holdings is a 2-star rated fund by Morningstar. Morningstar is a rating company out of Chicago that rates money managers. And it's a scale of 1 to 5. 5 is the best. This is a 2. And each of the last 4 years, it has been in the bottom quartile, the bottom 25% of money managers, and more than 500 managers are in that review. So it hasn't been doing as well as it could. Our manager selection process that Ted will talk a little bit more about would have weeded that out. We don't allow 2-star funds as part of our process. So a better performer just means more money in your pockets. So with that, I'm going to have Ted tell you a little bit more about how Fulton manages money. Ted?
Thank you, Mike. Good evening, everybody. As Mike said, my name is Ted Walden. I've been managing portfolios for 25 years and been with Fulton for 17. So Mike and I've worked together for quite a long time. I know we're pressed for time, so I'll kind of go through this fairly quickly, but I think it's important to recognize that when a group such as yours gives consideration to another firm, that you are interested and knowledgeable about the investment process as opposed to a sample portfolio. It's really simple for anybody to, as Mike mentioned, star ratings, go out and pick a bunch of 5-star or top rated funds and put together a sample portfolio with great performance looking backwards. But that doesn't necessarily help you going forwards based upon current economic and market dynamics. So I want to talk a little bit about process and have that be really the what you take away from this conversation. As I said, and as Mike said, we're fiduciaries. Our investment process is made up of 3 parts: strategic asset allocation, tactical asset allocation, and manager selection. That process is managed by our investment committee. There are 12 members of the investment committee, 12 portfolio managers right now. Most of us in Lancaster, Pennsylvania, but some scattered across our 5-state footprint. The investment committee really starts with, and the process starts with strategic asset allocation, which essentially is using historical data and performance and valuation data from different asset classes to develop forward-looking capital market assumptions and making an educated guess, so to speak, as to how you think certain asset classes are going to perform going forward. That strategic process essentially works on blending asset classes together to reduce risk. And portfolio performance obviously is very important, but risk management is really what drives the process for us. Secondarily is tactical asset allocation. Tactical asset allocation is simply overweighting and underweighting certain parts of a portfolio from an asset class perspective based upon current valuations and whether something is expensive or perceived to be inexpensive relative to the current economic environment, Fed policy, monetary policy, and expectations for economic growth going forward. A most recent example of a tactical change that our committee just voted on was to reduce our small and mid-cap exposure in portfolios. Very simply because we're kind of in the late stages of this economic cycle right now, and small and mid cap U.S. stocks tend to perform worse than large cap U.S. Stocks in that period. So as we continue to get to the end of this Fed rate hiking cycle with slower expected economic growth, reducing our small and mid cap exposure is the most recent decision that we've made. The third and maybe the most important part with the tactical asset allocation is manager selection. We are engagers of the open architecture. So open architecture means that when we are looking for investment managers, whether that is through a mutual fund or a separate account, meaning you as the client own the individual stocks or bonds that a particular manager wants to invest in. Excuse me. We're looking at a universe of managers as opposed to thinking that 12 portfolio managers in Lancaster, Pennsylvania can be the best stock pickers in the world. So we're looking to hire the best managers within each of their sub-asset classes at the lowest expense ratios possible so that the net return to you, the client, is as good as it can be relative to reducing expenses in a portfolio. If you have the presentation, there's one page that describes in detail the process and the screening process and how we get to the managers that we essentially have on our approved list that are available for the portfolio managers to hire to manage client portfolios. I won't go through that entire process, but it leads to a page where on page 14, where you'll see the names of some of the partnerships that we have with groups like AFG, or the Applied Finance Group, which is a group that's typically works in the pension world and is not the most well-known name like you might see with, a Vanguard or Nuveen or PIMCO or something along those lines. So we're looking for the best managers, and I think that maybe the most important thing that you can take away from this conversation relative to our manager selection process is that Fulton does not manufacture internal product. We don't have our own mutual funds or separate accounts that we manage. And the reason that is important is because if you have your clients invested in your own product and your performance falters for one reason or another, whether it's cycle driven or security selection driven, it's really hard to fire yourself. And so in my experience in this business for 25 years and looking at other providers or other clients types of portfolios and seeing a lot of internal product and portfolio, it really is evident that it makes it that much harder for those folks to fire themselves. So we remove all of that bias from our investment process and try to hire the best managers. And really, I think what that means is you're getting the best thinking of the available source of managers in the marketplace, as opposed to the best thinking of just one firm or two firms if the firm that you're working with is not searching the universe for the best of managers available for selection. So I'll stop there for just a second and kind of leave it at that from a process standpoint, as if there's any questions, as I know we're tight on time.
No questions from me. Any questions from either of the other committee members?
No.
Commissioner Gibbings? Okay. we very much appreciate your presentation. It's helpful context and information, and we appreciate your relationship, and we'll take it all under advisement. Thank you.
Thank you.
Thank you very much.
Have a great evening.
Thank you. You as well. We're going to move on to the next item on our agenda, and I would ask the town to disconnect the Fulton folks. All right, I think we're back to, I don't know who the last iPhone item is. Oh, that's gone too. Okay, very good. Next item on our agenda is town manager's presentation of financial needs and budget status. Bill, if you don't mind giving us an overview of where we stand.
Yeah, thanks, Brian. Sheena did another great job this year. For the year prior to set-asides, the town was about $1 million to the positive. With set-asides, we were about 80,000 more than projected. With a decrease, the surplus by 460,000, that leaves roughly 600,000 that the town netted for the year. To meet the rainy day and short-term requirements for the fund balance policy, the rainy day fund must have 50% of the FY24 operating budget, which would be approximately 2.1 or 2.2 million out of the 4.5 million, which is our budget. And as of the end of March, this fund was approximately $2 million. That left us a little short of 264,000, which will be allocated out of the 600,000 of the surplus in FY of 23. The requirement in the unassigned fund, which is 15% of the annual operating budget, approximately 680,000. As of the end of March, we actually had a balance in there of 833,000. So according to Sheena, and they're working her magic, that we don't need to put any money into that fund at this time. So we do have some leftover money from that. For the FY24, we're projecting a net set aside increase of about 426,000. After the funding of the rainy day, there's roughly 335,000 surplus left over there. And Sheena wrote something, there's a couple different things we can look at for that. And I agree with her that we should set a portion that aside to look at, possible salary increases next year of anywhere between 3 and 3.5%. And again, this is all Sheena's work. I'm just reading it to you. Sheena, do you have any other comments?
No, thank you, sir. You covered it very well.
Any questions?
No question from me. A couple observations. I mean, one, congratulations. Surplus in this world, in this market, is always amazing. So nice work, Sheena, and Bill as well.
Yeah, with no property tax.
Yeah, I mean, it really is quite remarkable. And second observation is, I mean, as to the other item you mentioned, salary increases, that's obviously not the province of this committee. So, while I, personally have a view on that, I don't think the committee really can comment on that. I think that's for the budget committee.
Yeah, I just wanted to let you know what we might do with some of that funds.
Yep.
One thing,
I mean, I'm supportive of it, to be clear, but I don't think there's anything for the committee to do about that.
last meeting, you had suggested, you had told us to get with Fulton about getting interest on our funds with them. Within 2 weeks of that meeting, they were able to get us set up where we are getting interest. I think it was close to 3%, Bill, on.
Yes, it is 3%.
On everything that we could get interest on that wasn't specified as non-interest per the grant requirements. So that was very quick turnaround from them.
That's fantastic, and that's precisely why we were asking. It's I don't want to say it's free money to the town, but it's money that we are capable of earning, so we should earn it. I think this is a question, I guess, to take back to Fulton at some point. Next time you are engaged with them, is whether 3% is really the best we can do. I mean, in fact, there was an article in the Wall Street Journal, I think today or yesterday, talking about banks having to sort of work harder to keep deposits. because the interest rates currently are actually even higher than that. We should, with the treasury rates where they are, we should be even able to get closer to 4%. So I would inquire whether that's even the best they can do.
I will be talking with them. When we first started talking with them, their powers that be had originally said closer to 2%. And Richie and Matt and that whole crew were able to get us the 3%. So
Okay.
I will be talking with them tomorrow anyway. So I will
Okay.
mention that.
Great, much appreciated. I don't have any other questions, but Dennis, Bernie?
I have a question. I don't know if it's proper to address it here, but much of our money is coming from permits, and how do we see that in the future? Because that's how we're going to invest. As most of the town's income is permits, I believe, and I'm just wondering how that's going right now.
No, it's
What-
going very well with building permits. Transfer tax is down, of course, but our building permits, business license have gone up. Part of that is because we hired somebody to work 4 hours a day, different days of the week, to go out and ensure everybody's got a business license and has a building permit.
Okay. Good.
Bernie, any questions? Or Commissioner Givens?
No, not for me.
Okay, fantastic. Thank you, Bill. Thank you, Sheena. Next item on the agenda is portfolio review with Dominic from Brown. Looks like he needs to be admitted in. Okay.
He is not in the waiting room. I did send him an email reminder with an invite for the Zoom this morning. I did not hear anything back, but he is not present.
He likewise had emailed me to tell me he was going to join, but let me double check, make sure I didn't misread it, find it. His email simply said when he realized the time was 6:30, he said, "See you next week." So I would expect he's joining, but we can give him a couple minutes. And then short of that, I think his presentation is also posted to the website online.
Yes.
Yep.
Yeah.
All right. Well, I guess in the meantime, while we're not voting on these items either, so let's jump ahead to 8 and 9. Any other business that the committee wishes to discuss or consider? Hearing none. Meeting dates, second Thursday, 5 p.m. The next meeting would be summer on July 13th. Note that for your records, but please advise if that time doesn't work. And assuming it's okay, if Kate, you don't mind putting that on the town calendar, we would be grateful.
What time again?
5 o'clock if that works, or we
Okay.
can make it later. I know Commissioner Gibbings, does
I
that
am-
time work for you?
I can do it earlier. It's just when we moved it, I already had patients scheduled. But if you
Uh-huh.
let me know 3 months out, I can just schedule my patients accordingly.
Is it better late? Later is fine by me if it's good for the other committee members, if that's more convenient to you.
I have total flexibility, so just what works for y'all.
Bernie, Dennis?
I'll go with the flow.
Yep, no preference.
All right. I don't know, I guess we can just keep it at 5 o'clock since that's what it says on the agenda.
Okay.
Okay? And are we going to continue to meet by Zoom? Or are we going to return in person at any point?
Matters not to me. I mean, summer is much easier for me to do in person than other times of the year, but we can continue Zoom or at least make that available.
Okay. Yeah, it was only that winter time that I ran over in the cold to discover it was in Zoom and then ran back and wait, that's the only time.
Sorry.
It's a problem. I got my cardio in for the day with that one.
Yep. All right, well, I'm not certain. Let me just make sure I'm not missing an email from Dominic telling us he's running late.
So what are our requirements for his report? Do we need to hear from him on a quarterly basis, or can we accept the written document?
I think we're required to review it quarterly. I don't know that he has to make a written presentation.
Okay, so do you want to talk the committee through it in brief time, or do you just want to say, everybody look at it? I just want to make sure we're meeting our fiduciary obligations.
Agreed. Let me see if I can pull it up from. Actually, I think Dominic actually maybe sent a written summary, so let me look for that. All right, I'm gonna, rather than trying to give my own gloss on it, I'm going to read what Dominic had sent in writing as a summary to me prior. If that is agreeable with the committee. So he wrote, the first quarter somewhat surprisingly produced good overall results across global markets to start the year. Most major global equity markets were positive for the quarter, and in some cases impressively positive. And fixed income markets also recovered slightly as interest rate and inflation concerns seemed to recede slightly during the period. We say surprisingly because the news since the start of the year has been anything but sublime, with new concerns about the health of the banking sector being heaped onto ongoing worries about the Ukraine war, geopolitical tensions, and the tug of war between inflationary and recessionary pressures. The collapse of and pressure on regional banks will likely weigh on economic activity while complicating central banks' efforts to slow down inflation. The current environment highlights how difficult it is for central banks to balance financial stability against the tighter monetary policy needed to bring down inflation. Bank liquidity has been challenged as a result of the fastest pace of interest rate increases since the early 1980s. Global systemically important banks, or G-SIBs, still have relatively strong liquidity, but the investors and regulators are paying close attention to banks that are at risk of experiencing a Silicon Valley type collapse. Further, we are all too aware that a collapse of a smaller institution always carries the risk of contagion, whether directly through counterparty relationships or indirectly from fear such collapses may produce among global depositors. All of these interrelated factors will be carefully considered by the Fed and other central banks in 2023 as they chart their respective interest rate trajectories. Leading economic indicators are currently somewhat pessimistic, suggesting that higher interest rates and quantitative tightening may begin to slow down economic activity. These indicators have fallen to a level that has historically preceded a recession. Inflation has slowed, but core services inflation remains stubbornly sticky. Wage growth and a tight labor market have buoyed prices for many of these core services. However, the resilience of blue chip and higher quality equities during this period suggests that the market still retains moderate confidence about future conditions. In the face of uncertain conditions, we have been seeking to position portfolios for downside protection amidst a potential slowdown, while also monitoring various corners of the market that may be oversold. We are seeing opportunities in fixed income across high quality bonds and a potential opportunity in small caps, which were hit especially hard by banking sector fears and now broadly offer more attractive valuations in our view. Overall, we have been defensively positioned in portfolios, increasing core fixed income and bolstering liquidity for many clients. We build portfolios to withstand a wide range of economic and financial market outcomes, and remaining patient may allow us to take advantage of dislocations should they arise. The market volatility and unexpected events that have marked the start of the year underscore the value of humility and prudence when investing for the long term. Rather than try to predict short-term fluctuations, we believe that maintaining a focus on the long term and planning appropriately are the keys to success. We look forward to speaking with you soon and welcome your thoughts and questions as always. So that is their overview of the market. Let's see. And I'm assuming we don't have Dominic in the waiting room, Kate?
No.
I am going to open the Brown presentation just for further comment from me. So this is just to summarize the account summary. I mean, this is available on the town's website. But let's see. Total accounts, each replenishment, little less than 3.3 million, makes up 2/3 of the total account. There's another account of 756,000 for beach replenishment. This is sort of the breakdown of it's largely invested in fixed income, lesser extent in large cap US equities, and even smaller 16.8% of the portfolio is in small mid caps and global and emerging markets. The total of the beach replenishment, which is a long holdings, is 4.833 million. The short-term account, 197,000. The general fund is 1.353 million. Grand total, the town has $6.384 million combined in the accounts. For the portfolio overview and performance history for the quarter, it looks like we have the quarter to date was 7.8% return, so consistent with what Dominic observed in his note to us. Equities have generally done very well. That is a big turnaround from the trailing 12 months prior, which showed a larger loss, 7.3% over the last 12 months. So this quarter is giving us a substantial rebound. The entire portfolio across the board is in positive territory. Even fixed income overall was a 1.9% return. So our total portfolio had a net, which is after fees, of 3.2%. Gross before deduction of fees was 3.3%. So the fees are pretty modest, 0.1%. And our blended benchmark is 3.5%. So on a net basis, we're trailing it by 300 basis points, which all things considered from my vantage point, that's pretty good performance. Not as great as he's done in some prior quarters, exceeding by a significant margin our benchmark, but he's very close. So that's good. Going down into some of the performance detail of individual funds, we're in taxable fixed income. We have a S&P 500, which is large cap equities. We have the Russell 2000, which is small cap. We have a global fund, and we have an emerging markets fund. It appears that for each of them, they are generally around the benchmarks. Our intermediate income fund returned 2.2% for the quarter versus a benchmark of 2.4%, so right on track. The equities, we've got a lot of outperformance there. The S&P 500 returned 7.5%. whereas the portfolio returned 9.3. Small cap, we returned 2.2% against a benchmark of 2.7. For the global, we bested the benchmark by 300 basis points, and on emerging markets, which has been a pretty underperforming sector, did pretty well. We returned 5.2% versus a benchmark of 4. That sector has the benchmark has been, for the trailing 12 months, was down almost 11%. So that's a big turnaround in that small segment of the portfolio. So overall, my view of what I'm looking at is this performance is very solid, consistent with what Brown has delivered in the past. Not quite as rosy as we've done in past quarters, but also still very good.
Brian, sorry to interject. It looks like Dominic did join us. He just
Hey,
jumped
hello,
on about a
everyone.
minute ago.
Okay.
Yeah. Hey, everyone. I'm very sorry for being late here. Wife's out of town and got caught up with my daughter, so I do apologize. I did catch Brian's kind of covered performance. Brian, anything else? You went through all the performance, is that correct?
I did. I mean, I gave my bird's eye view of it. You're welcome to provide your overview. That would be helpful.
Yeah, absolutely. So we'll go ahead and get into it.
And just to note, I have to go catch a flight, so I'm going to switch over to the telephone. But I think we've covered for the committee all business. I'll stay on the line by telephone in just a moment, though.
Okay, sounds good.
Thank you.
Okay, so absolutely. So let me just share my screen real quick. Let me do that. And we'll run through it. So yeah, I mean, all the performance that Brian had just talked about is, I would say, in line. Our managers are doing, for the most part, what they're supposed to be doing here. In Flex Equity, I mean, really, if you look at kind of long-term performance since 2015, I mean, outperforming the relative benchmark, the S&P 500 by 400 basis points, which is meaningful outperformance when you compound that kind of over time. And again, that's an annualized rate of return. In small caps, I would just say, just note kind of the timing and when we invested here, just during that time period, basically all the downside of 2022. Global Leaders doing, I think, a fine job in emerging markets has done well since we got back in to emerging markets back in 2019. So it went through kind of the short funds as well. So if you look at it kind of in the sections in which we typically look at it, the long portfolio kind of 4.8 million as of 3/31, and then the short 197,000, and then the general fund was a total of 1.35 million at the end of March. A couple things I would just kind of highlight. I think portfolio has gone through from an asset. I would say we're looking more at kind of asset allocation now, just given where we are kind of in the broader market. I would say two things. One, we're starting to kind of get earnings coming in really a little all over the place. We're definitely seeing some revisions from companies kind of revising down kind of the remainder of 2023, where I would say the broad market would say that within kind of this year, we will be in some sort of recession. What kind of recession that is, I think we'll find out when we get there. But markets are somewhat pricing it in, somewhat not pricing it in. Certainly, the bulk of the performance from the S&P 500 this year has come really from a handful, really 5 tech companies: Microsoft, Apple, NVIDIA, and a couple others. So the broad market has kind of not performed quite as well, but given the magnitude of those companies, that's really been the driving force in the market. We've certainly seen the Fed We certainly had the Silicon Valley, banking, call it a crisis maybe. But Fed stepped in with liquidity to kind of, I guess you could call it a bailout, but certainly a tool that they have in their toolkit to be able to step in really and provide that kind of liquidity, which certainly calmed things down after that. But certainly they're likely not done, and they'll probably have one more hike this year, is essentially what market's pricing in. But we may see them pause if we see company data come in through this earnings cycle, over the next, I would say, month. So that's kind of where we're at on the bank. We haven't seen any other failures. Certainly, there's with the rates market really doing what it has done. It certainly, some of those portfolios kind of got a little bit more in balance. So if you think about banking system, I would say still we're still fighting the Fed. We don't want to fight the Fed, and I think if we were here in this same place, this portfolio, 3 or 4 years ago, we would have probably we would have been thinking about kind of dialing up the risk in the portfolio, i.e. less in bonds and more in equities. And I would say now we're kind of in that opposite, where we're going more towards bonds, kind of less towards equities. And if you think about kind of some of the reasoning behind that is, if you kind of look at this right slide here, I think this is really the most telling picture in this deck, just to really see how the markets had shifted. So if you think back over the last 100 years, U.S. large cap equities have returned 10.3%. Core bonds, core fixed income, U.S. fixed income, basically 5%. So a differential about 5.4%, which we would call kind of the equity return premium that the market, you're taking more risk in equities and being rewarded, to the tune of 5.5%. Over the last 10 years, given the low interest rate environment that we really have been in kind of since the great financial crisis, has returned, higher than average, 12.2%. Fixed income, given the low rates during that period of time, only returned 1.4 with a differential of 10. And that's really why we've seen this big jump in the market, certainly over that time period, is because you weren't getting paid in stable assets. You were only getting paid really to take risk. And in that low interest rate environment, and it created a ton of growth across the globe, really, as most of the world was in that low interest rate environment. So here we are today. Interest rates have come up to, around 5%. And the forward-looking, thought of growth throughout the United States is coming down. And so the return profile, if you look ahead, the estimated return based on today's valuations in equity markets is about 7%, kind of out over, call it the next 5 to 10 years. And so that equity risk premium, the amount of money you're getting paid to take on risk, is down to kind of really a historic low. And so I think all of that said, the way this portfolio is already positioned, given its 75% kind of fixed income and cash and only really 25% equities, I think it's positioned well. I think it's right where it should be. The equity piece is really concentrated with really high quality equity portfolios, and the fixed income, kind of the same thing, right? High quality. We're not taking any type of credit risk. It's all kind of good corporate investment grade credit within that portfolio. So I'll stop there and certainly can open it up to questions, but I think that kind of outlines the portfolio and just really where we are at the moment. Anyone have any questions?
I don't have any questions. As I said earlier, it's the committee before you joined. I mean, I think the performance, as usual, looks pretty good. You've done a nice job compared to the benchmark. This quarter has looked, although outperformed in a lot of respects, with a little less outperformance than I think you guys have done in prior quarters, but only by a tiny bit. So, nice job.
Thank you. Yeah, I think it was just I think it was a tough year last year for everybody. There was really no place really to hide in a market like 2022 when rates went up at a really historical rate. So, I think we're starting to see now in this market where at least in equity markets where fundamentals matter, and cash flow and cash flow that can kind of be sustainable, can compound over time. That they're the companies that win in the end, when they can build market share during economic points of economic stress. And so that's a really ripe environment for really good fundamental stock pickers. And I think that's really how we position the portfolio. So I think we'll see over probably the next 12, 6 to 18 months, our managers should really perform well in this type of environment.
All right. Open it up to the committee. Any questions or comments?
No. I'm okay with it.
Okay.
Commissioner
No
Giddens,
questions for
any-
me. No questions for me.
I'm okay.
Thank you.
Okay, well, if no further comments, I think we should just thank Dominic for his time and Brown's good stewardship is continuing, much appreciated. And I think we've covered everything else on the agenda unless anyone has any other business they wanted to address.
No.
All right, hearing nothing, I think, do we have a motion to adjourn?
Motion to adjourn?
Is there a second?
Well, before we do the motion, we have to look for any public comments.
I'm sorry, look for any, say that again.
Public comments. We have to look for any public comments.
Okay.
Yeah, no one on Zoom now to make comment.
So are we clear to adjourn?
Yes, we are. I second the motion.
All right, all in favor, say aye.
Aye.
Aye. All right, it's unanimous. Meeting is adjourned. It is 7:28 p.m. Thank you very much, everyone. Have a great evening.
Thank you, everybody.
A great
Thank you.
evening.
Thanks, Gina.